Making the decision to become an ISA investor is the easy part. Working out where and how to invest your money can be a whole lot harder. But it doesn't have to be an uphill challenge. Breaking the process down into more manageable chunks will make it far easier to pick the right investments. Whatever your circumstances, understanding risk is crucial to ensuring you invest in the most suitable asset. Generally, the more risk you're prepared to take with your money, the better return you can potentially generate. Whether you're a naturally cautious person or a gung-ho adrenaline junkie, there'll be a suitable investment for you. It's possible to control risk by diversifying, which means investing across a range of different companies and assets to spread the risk. The idea is that if one company or asset doesn't perform well, the others will pick up the slack. Once you know what you're investing for, how long you're able to invest, and what your risk profile is, you're in a much better place to start choosing investments. Here's a quick guide to the major asset types. Cash savings accounts are considered relatively risk-free. The bank would have to go bust before your cash was at threat. And you're able to squirrel away over £5,000 a year in a cash ISA that's free from income and capital gains tax, but your money may be eroded by inflation. Bonds are loans to companies, local authorities or the government. So you lend your money to the company or the government and you're paid interest in return. The bond sector is often referred to as fixed interest. Investors can invest in the buy-to-let market or commercial property. That's shops, offices or industrial warehouses, and they usually do so via a collective fund of some type rather than directly. Equities, also known as shares, give investors a stake in a company. If the company does well, the value of the shares may rise and you may be able to sell them at a profit. Rather than invest in any asset directly, most beginner investors usually buy units in a collective fund, such as a unit trust or an open-ended investment company. And this is where your money is pooled with that of other investors, and a fund manager decides which investments to buy and sell according to the fund's mandate and risk profile. Independent financial advisors usually recommend that cautious or beginner investors minimise their exposure to equities and have a portfolio loaded with bonds, as they're generally lower risk, but you can adjust the mix of assets according to how long you have to invest or how much risk you're prepared to take. In our next video, we'll look at how you can build a portfolio of fund investments, whatever type of investor you are.